Welcome, everyone. Welcome to today's episode of the Market Wrap. Sir, it has been a slow but steady week. We have crossed 26,000 mark, and yet we are away from the ATH. What is the outlook right now, and what are we seeing in the markets?
Yeah, hi, good evening, Vishu. So I think if you look at the global markets, we have done a lot better. Last 2 weeks, we have seen a correction of nearly 5-6 odd % in global markets, largely in big markets like US, because there are now concerns of stretched AI valuation and potential bubble. And on top of it, no one is sure what kind of rate cuts or whether we are going to get a rate cut in US or not. So with that in backdrop, our markets have done well, delivered 3.5% kind of a return last 2 weeks. This week also is second week where the markets are up about half a percentage. Though the broader markets have not done so well, small caps have lost 2%. But good part is that since AI related themes have sort of started to cool off, a big sector like IT has started to sort of do well. And I think on top of it, BFSI continues to do well, and we have seen banking making new high. Even the mid cap index has made a new high. So our sense is that there could be some volatility in case if the US market corrects further. But net net, our sense is that we are going to relatively outperform. From a level perspective, 26,300 is what needs to be taken out for new high to be made. But from a support perspective, 25,600 is what the support is. And in case if we are able to take out 26,300, then 26,800 is what we should look at. So that is the kind of a range our sense is that one should be playing with. And I think all eyes are still on the US India trade deal. I think as and when that gets announced, sentiment wise, it will be a big positive for the markets. Good part is that some of the macroeconomic factors like the crude continues to remain soft. Though there are concerns in the rupee, rupee has made a new low today and sort of a worrying sign for the market from a sentiment perspective. But nonetheless, I think we are in a relatively sweeter spot compared to the global markets as of now.
Right. So Q2 is almost the entire Q2 results are almost out. Let's cover a few sectors one by one. Let's start with power sector. What is the snapshot right now?
So, Vishu, we all know that this year there has been an extended monsoon. In monsoon, the thermal power generation takes a backseat. Hydro does well, and wind also does well. But sum total demand during July to September quarter grew by 4 odd %. And consumption did not really pick up the kind of it usually does when the summer happens. And as a result of that, if you look at companies like say Tata Power, NTPC, Power Grid, I think all of them delivered a very muted set of numbers. So Tata Power 3% kind of a growth because they have a higher portion of renewable energy. NTPC again 3% kind of a decline. Power Grid 3% kind of a decline because they're largely thermal centric. And something similar in terms of profit numbers also. So NTPC witnessed a profit growth of 4 odd %. And I think Power Grid, the profit sort of declined by 4 odd %. Now, but till second half is where we are a lot more hopeful of the power demand being better. And we also should also note that last 1 year, power is one sector which has not done much. And I think government is looking to sort of do a lot more here from a policy perspective. So the other thing is that in the first half we have seen good amount of power capacity addition. So even a company like NTPC witnessed a lot more higher power capacity addition, and same is the case with Power Grid. But second half is where the generation should pick up. So relatively numbers should be better for all the three players. And I think Tata Power, NTPC, Power Grid look to be the best in terms of companies. Why we are liking this is that since there is a limited amount of money, so sector rotation can benefit the entire power sector and some of these companies in particular. Because from a longer term perspective, this year has been a record of capacity addition in all the segments, be it thermal side, be it wind or solar. But second half is where we would expect more of generation to happen and revenue to sort of come by. So probably a last half or in this half, nothing much happened, but second half is definitely looking better.
Absolutely, sir. Let's talk about public sector banks. They have seen some good greens in the past few months. What has been happening here?
So, Vishu, public sector banks have done relatively better compared to the private sector counterparts. One, on the profit growth side, on a cumulative basis, their profit is up about 9 odd percent, whereas our private counterparts, it's largely flattish. Now, one cannot complain about the overall asset quality, because when you look at from asset quality perspective, PSU banks are on par with private sector banks at this point in time, and with CASA being better in the range of say 30, 40 odd percent. And there is a reason for it. One, the PSU banks have increased their proportion of retail agri MSME, and that is where the majority of the growth is happening for most of the companies, along with housing. So a bank like SBI, 64 odd percent used to be contributed by RAM in RAM segment, which is the retail agri and MSME. Now that has gone up to 67 odd percent in this September quarter. So in the last 3 years, they're upping this particular segment, which again is a higher margin segment and witnesses lower asset quality concerns. So definitely that is helping. The other thing which is helping PSU banks to sort of outperform is that the government is looking to sort of consolidate from 12 public sector banks to probably 6 to 7 larger institutions. And along with that, the FI limit is expected to be raised from say 20% to 49%. So what will happen is that with better set of numbers, probably they might get better FPI flows as well. So PSU banks, on top of it, are relatively reasonably valued, and which is why I feel that they have done well, and probably they might continue to sort of outperform for a quarter or two compared to the private sector counterparts. And banks which we prefer is again State Bank of India, Bank of India, State Bank of India, Bank of India, Bank of Baroda, and Canara Bank. So from that perspective, I think PSU banks are in a bright spot, and probably will continue to sort of hog the limelight even in the second half.
Right. Another related sector is housing financials. What's our outlook on them?
So one is, Vishu, when you look at housing finance companies, penetration wise, it's quite attractive because mortgage to GDP ratio is at about 16 or 17 odd percent. And you compare that with any emerging markets, that's in the range of 20 to 30 odd percent, and forget the developed countries where it is about 50 to 60 odd percent. So yes, there is a good amount of scope for penetration. Then I think the overall GST reforms is definitely helping. It is one, you have got lower interest rates, plus cement cost has also sort of come down, and then premiumization is also there. So I think overall the affordability has gone up, and which is why when you look at most of your or some of these niche housing finance companies like say PNB Housing, they're targeting a growth of 17 to 18 odd percent. We had recommended Canfin Homes sometime back, which has got one of the finest qualities. So that is also sort of targeting a growth of 12 to 13 odd percent. And compared to that, when you look at the overall credit growth is still at about 10 odd percent. So and so they're definitely doing better in terms of growth aspect. The other thing is that margin profile is expected to be better because your cost of funds is expected to sort of come down, and that should sort of help them maintain better ROAs and ROEs. And so obviously these companies should benefit, and obviously some of the banks also, say for example SBI, HDFC, who have got a good portion coming from housing finance, should benefit. So yes, there are niche players in housing finance which are doing well.
Right. Another sector which has caught the investors' interest by storm has been auto and its ancillaries. What's the outlook going forward, sir?
So Vishu, post GST cut, auto OEMs have definitely done well. Now I think it is the turn of the OEM ancillary companies to sort of do well. Because in auto, last quarter we have seen 10% growth. Again, 6% is volume growth in domestic, and about 26% growth in the export side. Our sense is that Q3 is also expected to be better for auto EMs, which means that auto ancillaries should post a steady set of numbers for the quarter. So one particular segment which I would want to highlight on the auto ancillary side is the tire segment. Now, while the OEM demand is definitely better, our sense is that the replacement demand is also expected to be better because the economic activity has sort of gone up. And if this was not enough, what we have clearly seen is that the rubber prices and also the crude based derivatives or input prices have also sort of come down. So rubber prices, which were somewhere about 200 rupees a kg, is currently trading at about 186 rupees a kg. In fact, last quarter we had seen companies witnessing margin expansion, both gross margin and EBITDA margin. So our sense is that Q3 is where probably you'll see both margin expansion and better volume growth. So this is one segment which you feel can sort of do well. So Apollo Tyres is something where we have a buy rating, and here our target price is 605. So after I think OEM, it is the time for auto ancillaries to sort of do well.
Sir, another sector is hospitals. I think previous quarter as well, after the results, we talked about hospitals and we did like that space. What is the outlook right now?
So hospitals sort of continue to deliver in line because what we have clearly seen is that the hospitals continue to sort of deliver mid-teen kind of a growth. So even this quarter, 14% kind of a revenue growth is what they've delivered. And I think same matrix is sort of helping them. One, when you look at the patients which are covered by private insurance, those have gone up in the last few years to about 40 odd percent. And also the fact that the complex procedures now account for 25% of the overall procedures. And this was 15% last year. And most of the hospitals which have added in the last 5, 7 odd years, that they have turned profitable. In fact, ROCs have improved. And if this was not enough, the growth is expected to sort of sustain because the overall these top 6, 7 hospitals are witnessing or looking to add the capacities by nearly 50 odd percent. So this is one segment which continues to sort of deliver a very sustainable set of numbers. Valuations are on our rich side, but growth remains intact. And what we like is again Apollo hospitals are within the big ones, and KIMS and Rainbow Children in the mid caps side.
Right. And what's the outlook on electronic sector? We were in a whirlwind wherein first we were scared of because of the US tariffs, but then they did get a relief. What is the stance right now?
I think Vishu government is really promoting this sector because recently they have approved a total of 24 projects under the electronic component manufacturing scheme. And this has been done in two tranches. In the first tranche, which was approved in 27th of October, the committed investments were nearly 5,500 odd crores. In the second tranche, it is nearly 7,000 plus crores. And listed companies like say Kane, Sirma, and Ember have got major approvals. And the kind of benefit what they get is an incentive of nearly say 3 to 7 odd percent on incremental sales over the next 6 years. Then there is a capex incentive, so 25% of the capital investment. And then there is a hybrid incentive, which is a combination of turnover and capex. So I think the entire perspective is to again do more of value addition, and so domestic value addition is expected to sort of go up. And I think within companies, PCB is something which is attracting a lot of interest. So, for example, Kane's Technology has got an approval for about 3,800 odd crores or 3,280 odd crores for PCBs of multi-layer, some camera modules. Amber also has got approval for 991 crores for multi-layer PCBs. So from that perspective, this is one segment which is continuously witnessing the interest of the government. And I think if there is some relaxation on press note 3 in terms of whatever the investment which is expected to come from China, I think that will be added positive. What we continue to like is Sirma, Keynes, and Amber. Those some of these stocks have corrected, but these companies can easily be delivering 30% plus growth on the next 3, 4 years, and which is why they still carry a rich multiple.
Right. And how about textile sector?
So textile also has a sector which has taken a good amount of knock because of the US tariff. So there the government has approved a PLI of nearly 10,600 odd crores, and this will be available for the next 5 years. And again, it's dependent on the capex. So there is one category of 50 to 150 odd crore kind of capex in plant and machinery. Then there is other category of 150 crore plus. And largely, this is for man-made fiber or fabric or technical textile. But technical textile can be a big segment because our share is only 1% in the global technical textile space, which is very less. Similarly, for man-made fiber, it's a big market. Our share is again 3%. So I think companies are looking to sort of venture into this segment, and beneficiaries again are companies like Gokuldas Export, Pearl Global, Sangam India, Aditya Birla Fashion and Retail, and Arvind. So I think overall sense is that we are going to see a lot more better set of investment from these companies and newer revenue streams. And icing on the cake can be if the trade deal happens with the US, which can get announced any point of time, because it's one of the few major impacted segments of the overall economy.
Right. And finally, the hidden gem of the week, which will it be this time?
So while yes, we are in winter season, what I'm recommending a stock which will benefit a lot from the summer season. So it is Wonderla Holidays. It is one of the largest amusement park operators in India and has got 20 years of operations. They've got four amusement parks, which is in Kochi, Bengaluru, Hyderabad, and Bhubaneswar. And I think they are opening their fourth largest park in Chennai in the next month. And so our sense is that summer is the season when you have a lot more activity or a lot more visitors which come in, and that should benefit this company. So we are expecting a growth of about 16 odd percent next 3 years, which again could be a combination of 4 to 5% growth in footfalls. Then the incremental footfalls will happen in the new park, and then there could be some pricing increase of 5 to 6 odd percent. The other aspect is that the food and beverages or other segment can improve. So currently it contributes 25% of the revenues. Globally, it's about a ratio is 60 to 40 odd percent. 60% for ticketing and 40% for non-ticketing revenues. So companies looking to sort of up the non-ticketing revenues, which fetches better margins. So our sense is that the EBITDA margins will bottom out this year because capex for those parks have already happened. So margins should improve by 10% over the next 3 years. And that should help this company sort of do well in terms of about 16% kind of a growth in top line and 27% kind of a growth in bottom line. We have already seen this stock correcting by about 40 odd percent. So it is available at attractive valuations. And which is why I feel that while yes, summer is still some time away, but this is the right time to sort of enter the stock, considering the medium-term earning growth visibility. So which is why we recommend this with a target price of 750.
Right. Well, this was it for this time. Thank you so much, Pankaj sir, for your time and insights. And thank you so much, everyone, for watching. If you have any questions, please put them in the comments and we'll try to get back. Thanks again.
Thank you so much.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.